Hello and welcome to the real estate market update for July 2023. We will be looking at the numbers posted in June as we are halfway through the summer selling season. My name is Dennis Maynard. I am a real estate broker in Los Angeles. Please don't forget to like, subscribe, and follow. Now, this morning's CPI, or rate of inflation, came out under expectations with core inflation at 4.8%. The stock market rejoiced. Angels sang. Atheists came to Jesus. All praise the heavens as the salvation from the Fed is coming. No. This is still above the Fed's target, and shelter inflation is still running at close to 8%. The dollar index, DXY, also known as the Dixie, fell dramatically. The Dixie reflects how other currencies are trading against the dollar. This means that as the US dollar gets weaker, commodities and hard assets will get more expensive, more dollars to buy the same goods and services. This is partly why the bond market is pricing in another rate hike in July. Like the 1970s, we're in a rolling period of inflation, sometimes higher, sometimes lower. Mortgage rates printed an average of 7.04% last week for the 30-year fix. As predicted, rates are expected to continue higher after all-time lows. I call this the normalization of rates. It's important to remember that the average 30-year fix since the 1960s was roughly 7.5%. We just came out of a 15-year period in which rates were kept artificially low. This spurred inflation along with massive government money printing. It's the same thing, in case you didn't know, bonds and the printing of money. To demonstrate how low rates went, here is a chart from Elliott Wave International. We saw the 10-year Treasury drop below 2% in 2020. The last time we saw this happen, 1942. You can see what happened after and where rates went from there, only this time it's much more aggressive. With rates climbing, one would think that people would stop buying houses, right? Nope. Nationally, pending home sales appear to be keeping pace with pre-pandemic levels, all of which are below 2020 to 2022 levels. However, the number of listings on market still remains extremely low. 1 in 7 homeowners are choosing not to sell this year, citing high mortgage rates. And 4 in 5 home shoppers are rate locked or can't get a new mortgage at the same rate as they previously had. Hence, buyers are not listing homes to purchase new ones. This is supporting list prices as affordability continues to be a challenge. In Los Angeles County, new listings, active listings, pending sales all remain near decade lows. Closed sales have crept up some, but still remain near lows. The average days on market is 28, while the month supply is 2.4 months. The median sale price for a single-family home in LA has recovered some to $950,000 in June, down 4.5% from a year ago. The median sale price for a condo in LA is $630,000, down 3.8% from a year ago. The key takeaways are, while inventories are low, there are still buyers out there purchasing at higher rates. In order for prices to fall dramatically, inventory would have to triple, or buyers would have to stop buying altogether. Right now, we're not seeing either of those. If you're waiting for the housing market to crash, it's unlikely. Remember, the vast majority of homeowners have cheap mortgages. Why would they want to leave them? They have a home that they can afford the payments on. If you're a home purchaser, get out there and find the home that you can afford. If you're a seller looking to downsize, it's a great opportunity to cash in. If you need help buying, selling, leasing, or investing in real estate, please reach out. My team is ready to help. And I'll see you in the next video.